Welcome to the Business Talk, a global podcast series that highlights distinguished faculty members and their impactful scholarly contributions. I'm Deepak, your host from India. We are honored to welcome Dr. John Cochrane and Dr. Klaus Masuch as our distinguished guests on Business Talk today. Before we get started, I would like to introduce today's guest. Dr. John Cochrane is the Rosemary and Jack Anderson Senior Fellow at the Hoover Institution, Stanford University, and a leading voice in modern macroeconomics. He is the author of influential works including The Fiscal Theory of the Price Level and Asset Pricing, both published by Princeton University Press. Our second guest for today's episode is Dr. Klaus Masuch. Dr. Klaus Masuch has been closely associated with the European Central Bank since the inception of the euro. Over the years, he has held several senior roles, including head of the Monetary Policy Strategy Division, head of the EU Countries Division, and has been serving as a principal advisor since 2014. He earned his PhD from University of Würzburg in Germany. Our third guest, Professor Luis Garicano, is unable to join this episode due to his travel schedule, but we extend our heartfelt thanks to him and his fellow authors for making this book truly engaging and impactful. In today's episode, our guest joins us to explore the key ideas from their compelling book, Crisis Cycle, Challenges, Evolution, and the Future of the Euro. Let's not keep you waiting. Please join me in welcoming them to the conversation. Dr. John and Dr. Klaus, it's a distinct privilege to welcome you to Business Talk. We sincerely appreciate your gracious acceptance of our invitation.
Thanks. It's a pleasure to be here and always glad to talk about our book.
Same here. Thank you.
Thank you. Professor John, when you look back at the original design of the euro, what did its architect get most right? And which early design compromises do you now see as the seeds of today's vulnerabilities?
Thanks. I see you've done your homework because that is one of the central points of our book. The euro is a currency union without a fiscal or political union. A bunch of countries decide we will use the same currency, but we're not going to become yet one country. Now, if you do that, the central fact is that countries, like companies, must be able to go bankrupt without leaving the euro. They cannot say, we borrowed too much, crisis, come print money and bail us out. If you do that, you can see you're going to get inflation and an unstable currency. Now, the people who designed the euro understood this problem very well, and they put together a lot of restraints to keep countries from getting in exactly that kind of trouble. The European Central Bank, for example, is a independent central bank. It has a single mandate, price stability, nothing else. Originally, the European Central Bank wasn't going to buy sovereign bonds at all, unlike most central banks that buy sovereign bonds and issue money. Countries would abide by debt and deficit limits, so they didn't get into the kind of trouble where you'd even have to ask the question, are we going to bail them out by printing euros, or are we going to let them go bankrupt? And for the 1990s, you have to admire how prescient that was. Nobody was thinking about sovereign defaults outside of the brilliant architects of the euro. But, like any time you're building something new, they didn't fill in every detail, and they sort of figured, well, you'll figure it out as you go along, which I think was also quite right. So we're not particularly criticizing them. But if we could go back, there's a couple of little details there that were left out. One was they never really could say out loud, countries will default if they get in enough trouble. And so there wasn't a mechanism to allow default. There wasn't a sort of IMF-like mechanism to provide help to countries that are on the edge, because we economists love to think that there's default or not default, there's solvency or insolvency. No, there's a big muddy middle where you can reform the country and get back to paying back your debts, or you might go under, and a mechanism to help like that, which one of our key recommendations was missing. And third, they were unable, the bank regulators, which stayed in national hands, were not subsumed by the ECB overall. Bank regulators never were able to say that sovereign debt is risky. So banks have an incentive to hold sovereign debt over, say, corporate debt, which is just as risky. and worse, to hold the sovereign debt of their own country. And that means if a country needs to reschedule, default, force a haircut on its bondholders, as corporates do, suddenly the whole financial system is in trouble. And that leads to that's a bigger incentive for the ECB to want to bail out. So those are the sort of little problems going in. And I think everybody figured, we're all going to get along here, and we'll add those details later. But then, as I think you're about to ask Klaus, those little details didn't get fixed.
Professor, you argue that much of the Euro's current architecture is an accident of history, shaped by responses in the heat of crisis rather than deliberate design. Can you walk us through one concrete example of how a short-term fix during a crisis permanently changed the system?
I think that one's for Klaus, because I went on way too long in my first answer.
Yeah, I can. No, no. John, you wonderfully prepared the kind of the introduction and the scene. Now, Deepak, to your question, as John said, there was nobody thought when the treaty was written that the sovereign default could happen. There were fiscal rules. Countries should not have more deficit than 3% in normal times or 60% debt. And everybody thought the fiscal rules would work, so there will never be a need to think about default. And then in 2009, Greece had a new government, and the new government revealed that there was a lot more deficit than everybody had thought at the time. And that started slowly, but it started a debt crisis in Greece. And then people suddenly realized exactly what John said. There was nothing prepared for this event. There was no European institution who could act like the IMF, consider a bailout, loans, conditionality, and so on. We didn't know what to do if there is a debt restructuring. Banks were full of Greek bonds, so these banks certainly were not happy to think about restructuring and so on. And what happened then was that ad hoc solutions were decided initially, and that is what many people don't know. Initially, in the time between 2009 autumn and 2010 May. In May, the final bailout by member states and the IMF for Greece was decided. But in this 8, 9 months before, the ECB already started to do a kind of hidden bailout because the Euro system monetary operations were working such that the ECB gave a lot of loans to the Bank of Greece, the National Central Bank of Greece, and these loans had no conditionality, they had no maturity, and they had certainly no conditionality attached, no maturity, no risk premium. So there was already a bailout via the Euro system going on, but it was hidden. And of course, when then the official bailout came via member states, the ECB was somewhat relieved because then finance ministries, fiscal authorities did what they should have done from the beginning, helping Greece with loans and with a program, with conditionality. But then when the program was decided, and that was the initial sin, the ECB started nevertheless to buy bonds of Greece and of two other small, middle-sized European countries, Euro area countries, namely Portugal and Ireland, who were also in trouble or who were close to go into trouble. And this initial purchase in May 2010, when the member states had finally decided to put fiscal authorities, member states' money on the table and to help Greece, and so to help that the ECB could withdraw itself to go out of this implicit balance of payment support, or not implicit, this balance of payment support via its monetary framework, then the ECB decided nevertheless to buy bonds of Greece and other fragile countries. And I think that was the initial kind of sin. One can understand why it was done, because the Greek bailout seemed not to be credible at the time. the spreads of Greece soon after the announcement of the Greek bailout were increasing. Also, the spreads of Portugal and Ireland. One can understand why this was done, but this was kind of an initial action by the ECB stepping into quasi-fiscal policies, which then happened in different ways in future crises as well.
Dr. Klaus, the European Central Bank moved far beyond its original narrow mandate, using tools like large-scale bond purchases and extraordinary lending to banks. In your view, where is the line between legitimate crisis fighting and crossing into quasi-fiscal or political territory?
I have just outlined one example, namely this S&P program in starting in May, which I think is with the benefit of hindsight going into quasi-fiscal policy. It is understandable that this happened at the time because nothing was really prepared. There was a lot of uncertainty. But then after 2010 May, when the ECB started to buy bonds, member states and the ECB should have said this should not happen again. We need to design a mechanism. We need to set up an institution. We need to reform the Euro framework such that in the future the ECB would not again be drawn or be thinking we are the only game in town. We have to do quasi-fiscal policies. We have to prop up bond prices by announcements or by purchases. But this did not happen. There were some reforms in 2010, 11, 12. Also the ESM, the European Stability Mechanism, were set up, which were going in the right direction. But these reforms were not carried through. Some of them were later watered down. So then in the end, the ECB was again in the next crisis, especially in the pandemic. It saw itself as being the only game in town. And I think it's not a legal assessment. We are not saying the ECB violated the treaty, but from an economic perspective, these actions of the ECB, which you have quoted, go very far into fiscal policy, and especially as the ECB uses its monopoly power to print or issue money and buys risky assets, risky sovereign debt, gives loans to subsidized loans to banks. It redistributes costs and risks across between member states, between savers and borrowers, and between taxpayers and bondholders. And these kind of redistributions should normally be decided by parliaments and governments and not by an independent central bank. This is, I think, the limit.
Let me add to that. I want to make sure we're clear. We're not telling a morality story of bad people. And we are not criticizing the bailouts that happened. Once you're in a crisis, you're going to bail out. And I'm going to bail out, and Klaus is going to bail out, you're going to bail out. All this tough talk evaporates when you have a crisis, one way or another. And the Greek one in particular was something nobody had anticipated. So it took a long time to get to the right solution. That's not our criticism. Our criticism, if there is one, is the failure in between episodes to say, we got to clean this up and not let the problems happen again. In particular, we have to mop up the moral hazard. And moral hazard is a fancy word for once you as a central bank start bailing out, then people come to depend on the bailouts. And we have understood this for hundreds of years. Bank runs have been the same problem. This is the problem of all financial regulation. In a crisis, in a run, the central bank or the government bails out the debtors to stop them from running. But once bank knows, the government's going to come in and bail us out if things get wrong, that's like, sending your drunk uncle to Las Vegas with your credit card. So now you got to do something to stop that moral hazard. And that's really the central part of our criticism. And a lot of it snuck in. So an example, fiscal transfers are happening. And one example is in quantitative easing, the ECB bought a lot of sovereign bonds, all our countries. But the way it handled it via the national central banks amounted to letting countries who would normally have to pay 5-6% or so for their debt to borrow via the ECB at very low interest rates. So that's a straight transfer from one country to another. So they are doing policies with fiscal consequences. They asked about the mandate. The mandate was price stability, and the ECB is very sensitive about this. They always start every explanation of anything they did within the context of price stability. We have to blah blah blah. But I'm less polite than Klaus, so I'll be the one to say it. These excuses are getting pretty strained. Every time Italian bond yields go up, the ECB says, oh, we see fragmentation and dysfunction in the markets. So in order to preserve the monetary policy transmission mechanism consistent with our price stability mandate, we have to go buy Italian bonds once again. And that's, that's how they would answer that question, but it is looking pretty thin.
Professor John, a central theme of the book is that repeated European central bank interventions have raised expectations of routine bailouts. How has this shift in expectations changed the behavior of governments, banks, and markets inside the Eurozone?
Yeah, that's the moral hazard problem, which sounds abstract, but it's true. If if a government expects that in any crisis the ECB will come and will buy up its bonds and bail it out, then the government has less incentive to borrow wisely and have plans for paying it off. And most importantly, for the kind of politically painful microeconomic reforms that get countries going again. Similarly, if we all know an ECB bailout is coming, in fact, perhaps even more strongly, people who hold the bonds have no incentive to proper risk management. If you're a bank and your regulators say, hey, this stuff is risk-free, don't worry about it, and you expect the ECB to come in and bail it out, then you have little incentive to diversify your risks, to get out of sovereign risks into non-sovereign risks. And so the banking system becomes more fragile. So, if there's too good a fire department, then people leave gasoline in the basement. That is, I think, the central reason, the central problem. And it is very tempting for a central bank or any government institution. The crisis comes, we pour gallons of water or gallons of money on it. The crisis is over. Yay! We solved the crisis. We're ready to go next time. But easy to leave aside the fact that you have made things more fragile for the next time around.
Professor, the book emphasizes that monetary and fiscal policies are deeply intertwined in a currency union. What is the most misunderstood aspect of this entanglement when it comes to the euro, especially by politicians or the broader public?
Well, I'll start and then let Klaus. We should probably both dive in on these because. But what you didn't say in your introduction, Klaus was at the ECB and was at hand for the whole Greek affair. So Klaus really knows what he's talking about here, and that's why I will also encourage him to answer this one. But it's not. I don't think it's obvious to most people how deeply intertwined monetary and fiscal policies are right now around the world. And I think that is going to be a central issue going forward that we're not very well prepared for. I'm in the US. We have a 100% debt to GDP ratio. Part of why President Trump has been arguing for lower interest rates is to hold down the interest costs on the debt. So there's a monetary fiscal interaction right there slapping you in the face. And the US has not been in this situation since after World War II, when the government told the Federal Reserve, you shall hold interest rates at 2.5% because we don't want to pay any more than that as interest costs on the debt. So we haven't thought about that since World War II, but that is the brave new world of large debts everywhere. And it is also true in Europe. And I think that wisdom of the founders of the euro, that monetary and fiscal policy are one. So in some sense, it got lost because the ECB is in charge of monetary policy alone. And there was this hope that the ECB by itself can contain inflation with monetary policy, and we'll just carve those off and pretend they're separate. But they're not separate, as the ability of the ECB to buy government bonds to help them fund their deficits makes clear that they're not separate. And I think where both of us worry is the next crisis, where in the COVID era, the governments in the US and Europe um, borrowed an enormous amount of money and got the central banks to buy up an enormous amount of that debt, which contributed to the inflation we had. In the next crisis, it'll be worse. The ECB already holds a huge portfolio of sovereign debts. And I think if we have another crisis where our governments want to borrow immense amounts of money and have the ECB hold down inflation by buying the debt, it's going to be worse. So we are right in the land of fiscal and monetary policies are two parts of the same coin. And most people don't think about it. I think we've grown used to the world as it was in the late 20th century, where fiscal things didn't really matter, but that's not our world anymore. Klaus, can you help me out on this one?
Yeah, wonderful. I think you just said the government wanted the central bank to hold down inflation. You meant, of course, interest rates in
Oh,
your,
yes, thank you.
yeah. So no,
A crucial little detail there.
but your answer is perfect for me to follow up. What John said, the bigger scene of the interaction of fiscal and monetary policy, and I like to go into one detail which I think many people don't understand. When the central bank uh, issues money and buys long-term government bonds. That's quantitative easing, or sometimes, as I explained before, it may be in the euro area helping a few individual countries with fiscal troubles. But that doesn't matter. What happens, the central bank doesn't just print money or issue electronic money. The central bank gets short-term debt. It gets indebted relative to the banking sector. The central bank issues short-term debt called deposits of the banks at the central bank or called reserves of the banks. They are remunerated, which is something new, which was not the case, normally not the case in 50 or 40 years ago. They are remunerated. So the central bank becomes more indebted by issuing short-term debt, and they buy the long-term debt of the government. But what that means is the central bank is part of the public sector. What people perhaps don't understand, the central bank profit and losses after the operation costs, the staff costs are discounted, are normally mostly distributed to the government. So the central bank is part of the government sector, or the public sector. Now, what happens if the central bank issues short-term debt and buys its own debt, called bank reserves or bank deposits, and buys long-term debt of the government? It shortens the maturity structure of the consolidated total public sector debt. What does this mean? That in case the central bank thinks or has to increase interest rates to fight inflation, now the same increase in interest rates hurts the public sector much more. Because the central bank has done tons of QE and shortened substantially consolidated government debt. Now its increase in interest rates goes much more swiftly and much more heavily into public deficits if the public sector doesn't increase taxes or lower spending. And that's what people don't seem to understand. And how does it show up? It shows up, this cost or these problems, it shows up as we have two separated balance sheets. We have the balance sheet of the central bank and we have the balance sheet of the government sector, which are normally kind of in view of most people are not consolidated. Some economists sometimes consolidate them to understand what's happening. If you don't consolidate them, the central bank, and that's the fact, in reality, the central bank has its own balance sheet. It has to increase interest rates. This means that the huge amount we have, the ECB, I think, issued at some point 4.5 trillion, had 4.5 trillion short-term debt to the banks. So now the ECB had to remunerate this 4.5 trillion, which was first negatively remunerated to 1, 2, 3%. And that meant that the central bank, the user system, had losses because they remunerated these short-term debt, which was huge, at increasing interest rates, but the interest rates they are receiving on the bonds they had bought a few years ago were 0 or 1. And this losses which then the central banks accumulated is just the other side of the coin of this shortening of the duration of the overall government debt. And I think these mechanisms are, for most people, difficult to understand.
As the European Central Bank takes on more crisis management roles, it inevitably gets down into political sensitive decisions. What guardrails or institutional changes do you propose to protect the European Central Bank's legitimacy while still allowing Europe to manage future shocks effectively?
Well, I'll
Thank you.
start. Oh, go ahead,
Yeah, you
Klaus.
start. You start. No, you start.
So I was just going to echo a point Klaus makes. When you lend money to a government that's in trouble, that's like your brother-in-law comes in and says, I need a loan, and you say, okay, I'll give you the money to get you through till next Friday, but no gambling and no going down to the bar, okay? So that's how the IMF works. That's how lending to a government in trouble works. Uh, and the conditionality that Klaus mentioned earlier is you say, here's some euros, but you gotta solve this budget deficit problem, and you gotta, clean up, get your microeconomy working and liberalize your markets, and maybe, we'll find a way for you to pay us back. Those are intensely political things to say. If I say, Deepak, here's some money, but you gotta tell the public employee unions they're not going to be able to retire at 52 anymore, and you gotta tell your health insurance, yeah, you gotta pay $5 copay, and you gotta clean up the subsidies and industrial policy. Boy, that's very political. And I think I think we worry that it's quite dangerous for a independent, apolitical, technocratic central bank to be coming in and telling countries to do things like that in return for crisis loans. It makes it a political institution. It makes it, the countries then can say, oh, it's the evil European Central Bank that's making us, fire these public employees or whatever it is. And that undermines support for the central bank, and then everybody understands the central bank as being political. So that's why we really think it's important. If there's going to be crisis support, it must come with conditionality, and that should be done by a politically accountable European institution. Where I'll now pass it off to Klaus, who's a big fan of this idea. Go. Did I do a good job with the intro?
No, it's again wonderful, wonderful intro. Exactly where I wanted to answer. Um, you ask Deepak what institutional change, what reform, what guardrails. Of course, one could argue we have to change the treaty, which is the basis, the legal basis, but this can only happen with all member states agreeing, which is currently very, very difficult. So what we are proposing is to set up a strong European fiscal institution. We already have something like this, but it would have to be very much enhanced and reformed. So we prefer to speak of a new European fiscal institution. And what this institution needs to do is to fully unburden the ECB, the central bank, from all fiscal troubles in member states. What is strange now in the setting is that the ECB has announced, and this is something which we quite strongly criticize, where the ECB says, okay, we look at it, and if it's not justified by fundamentals of these member states, we will purchase bonds of these member states to get the interest rates down. Now, this is totally upside down of what a crisis management should look. If a country has a problem, normally there are some past policy decisions of the country which were not good. Maybe there are exogenous shocks, external shocks, but normally a country will not run into deep fiscal problems, having to pay higher and higher interest rates if they had done perfect fiscal, monetary, and regulatory policies. Now, if a country runs into higher spreads, meaning higher interest rates than other euro area countries, much higher, first the country should think, what can we change to improve our situation, to improve our credibility relative towards the market? What kind of, John spoke about these issues, what kind of reforms, what kind of conditionality can we do ourselves? But hey, we have the ECB who does the spread squeezing thing even without asking officially, transparently, the country whether they want it. So we have set it up wrong. Should say we have a European financial institution which has all the powers and is, as John said, not independent. These are representatives of the finance ministries of the participating countries, and they vote with majority to decide whether or not to give a loan to a country. And they decide, and they wait for the country to approach them. They are not sitting there and saying, "Oh, the interest rates go up, let's do something." They say, "Look, you can approach us if you have a problem, country A or B, you approach us. And if you approach us, we think about whether we give you a loan, what conditionality could be. We can discuss these issues. John mentioned them. And we see whether we need a debt restructuring before we give you a loan or after." And all this should be a clear process where the member states in trouble is in the driving seat. Whether or not they want help, they should approach the EFI, we call it the European Fiscal Institution, and we would not want them to approach a central bank. And we would certainly not want a central bank which acts on its own to squeeze the interest rates of a country which has not even tried to implement reforms to get the spreads and the interest rates down.
Let me just emphasize something Louis said, because we focus on the crises and what happens when there's a run or whatever. But there's this long period when interest rates start to go up and markets are screaming, we don't really trust you that much. And this is when the ECB has jumped in and held down the rates, which silences that market signal of, I need to pass policies that will convince markets that we're able to pay back the debts. Well, without that signal, countries don't hear the bad news coming before it hits.
Professor John, you highlight the tight link between banks and their own government's debt. What reforms to banking regulation and supervision are most urgent to ensure that a sovereign crisis does not automatically become a banking crisis in the next downturn?
Yeah, well, the outcome has to be what you just said. So we can get there in lots of different ways. But the situation where banks and other financial institutions will fall like dominoes if there is any restructuring, markdown, or other problem with government debt, obviously is that makes the ECB ever more likely to intervene. So it's got to stop. And the most obvious is that banks are now, as I mentioned, sovereign debt carries zero risk weight. In addition, bank regulators love sovereign debt and they treat it as a liquid asset. So there's actually a positive incentive for banks to hold sovereign debt. And the local governments, they're not dumb. Their regulators like their banks to hold their sovereign debt, because if you're trying to borrow money, there's nothing like the banks showing up and lending you the money. So the answer is sovereign debt has to be in hands that can bear risks. That can mean banks holding diversified portfolios of European sovereign debt. That can mean finally getting around to banking union, where pan-European large banks operate. So, if you have one big bank that works, a big bank that works all over Europe, then if one country's debt goes down, that doesn't really affect the total value of the bank. And we should also encourage private assets. So once you think of sovereign debt as risky like corporate debt, then that should be held in pension funds, in money market funds, in mutual funds by fundamental investors who earn a nice rate of return in good times, but in bad times can't run to get their money out and cause the system to fail. So just, once you say this is risky debt, the 15 ways of solving it appear overnight.
One of the key recommendations is a common fiscal institution that can support countries in trouble, somewhat like a European IMF. How would this body differ from today's European stability mechanism? And what political hurdles make this reform so difficult?
That's a Klaus question.
Yeah, I can go first. Thanks. Yeah, indeed, we are saying clearly in the book that either you set up a new institution we call it European Fiscal Institution, or you strongly reform and enhance the current European stability mechanism. So how it should be stronger? First, it needs more capital to be able to have a bailout of a large country, which currently seems not the case. Second, this institution should, in normal times, it should act alone, like the IMF acts alone outside the European setting. There should no longer be a troika. You know that in the crisis, sovereign debt crisis, which started with Greece and then Ireland and Portugal in 2010, 11, 12, and then 13, Cyprus, there was always this troika. So there was the IMF, there was the European Commission, and there was the ECB. And these three institutions went together to discuss with the governments the possibility for loans and what the conditionality would be. And they monitored they monitored the commitments of the government, which the government made, say the Greek or the Irish or the Portuguese or Cypriotic government made in order to get the loan. So it was this troika. We would say the EFI is alone there. The ECB should not be in the troika. I was myself responsible for the ECB working in the troika on Greece and Ireland. But certainly, I would say this is not the optimal solution. The optimal solution is, and this is still the solution in the secondary legislation, that the ECB and the Commission and possibly the IMF and now the ESM would work together in a troika or a quadriga or whatever. I would say the ESM should be alone, should do it alone, and it should have all the powers and necessary staff, and they should be allowed what they are currently not to do, like the IMF does, say annual monitoring missions to the countries, especially the countries which they think may be close to fiscal problems or may have debt sustainability problems. So, in a sense, it is an institution which is more powerful, which fully accountable to parliaments and governments. The highest representatives are finance ministers of the participating countries. And yeah, they should be able to act alone and set conditionality and everything. And certainly they should be able to decide whether or not the program which the government suggests is sufficient to give loans, because they give loans of European taxpayers, and they should try to see that these loans are paid back, and that requires a credible program of the government to reform and to say cut spending or do reforms which enhance growth. And all of these should be assessed and decided alone by this European fiscal institution, not by a troika or quadriga, which is highly complex to have 3 or 4 institutions sitting around the table, one government and 3 or 4 institutions. That's not very efficient if I could set up kind of the ideal solution.
The book argues that sovereign default must remain a credible possibility if the system is to be disciplined. Practically, what would a well-designed default and restructuring framework look like in a Eurozone? And how do you avoid turning it into existential crisis for the currency?
Well, I think that's, you need the possibility, you need the debt to be in hands that recognize the possibility, you need legal structure of what does default mean, you need the common fiscal mechanism to provide, halfway that, the equivalent of debtor in possession, and bankruptcy courts, and just the minute you say this debt can default without causing the euro, you've the necessary reforms follow quickly. I don't have much more to say on that one. Klaus, do you have details on that one?
No. I think you said
you laid out what the institutions look like.
I think in order to have a credible debt restructuring mechanism, all the things which we have proposed should be there. No, I mean, as John's outlined very much earlier on, that the bank should not be full of government bonds, because then a debt restructuring means the banks are in big trouble. We need this European fiscal institution to organize this process in a transparent manner, to be a clear counterpart to the government which is in crisis. And I think these are the two most important, and the other thing is transparency. It should not be it should be very clear who is in charge, namely the government, which is in crisis or which feels to be in crisis, should first try to do its own homework, try to reform, and if that is not sufficient, then they should approach the European Fiscal Institution. And if that institution says, okay, we don't think that your debt is sustainable, we don't think that the proposed reforms are sufficient, then you need a sovereign debt restructuring. But that's not to be decided by a central bank. The most important part of this mechanism, whatever is, the central bank should stay out of this hugely political and with huge distributional consequences decision. Yeah.
I'd
Which
like
in
to
part is a
yeah, please.
refinement of what, so there's, contagion, financial stability, and so forth. And that has turned into, that's all very vague and nobody really knows what they're talking about there. So, clarify, I would say, the limits of the ECB's role in financial stability has turned into the view that nobody anywhere can ever lose money on a mark-to-market basis. And we need to clarify much sharper limits on what financial stability means if the ECB is going to be in charge of it.
I would like to conclude this episode with one last question. If the euro were to face a major new shock in the next decade, whether from demographics, geopolitics, or another financial disruption, what would you most like to see done differently compared to the responses from 2008 to the pandemic? And what gives you optimism that these reforms can actually happen?
Well, let me start on that one. If you go into it the way we are now, nothing different can happen because everyone expects a bailout. The ECB has the tools, firmly committed to buying up sovereign debts to keep spreads from changing. And what will happen is a river of money. This time will probably cause inflation much more quickly than last time because everyone just saw it happen. And that shock always comes sooner than you think. If you think you have, decades to fix things, no, you probably have years. If you think you have years, you probably have months. We may be seeing it right now in the Straits of Hormuz on the way. So how do you get out of it? You need to pre-commit that, how are we going to do things next time, which means how are we not going to do things next time? Odysseus had the key. He had himself tied to the mast so he can listen to the sirens. So you can only stop yourself from doing things if you are clearly pre-committed that you can't do things. And the heart of the ECB's single price, it has a mandate, single mandate prices. That means and nothing else. Single mandate doesn't mean prices and then move on to other things. And the ECB, like central banks around the world, went into bigger and bigger efforts. It interpreted financial stability more and more broadly to sort of become a grand central planner of the entire financial system. Many central banks interpreted their role as we're going to save the world from climate change and inequality, which was bigger things. They have become the grand macroeconomic planner. They worry about credit cycles and so forth. But the more you do, the less you are effective at anything. You're more effective as a central bank if you have pre-committed not to do things so that everybody else will do their job and make sure that they're taking care of the risks. So, limiting the mandate is the most important, together with the presence of an alternative. No matter how limited your mandate and your understanding that we do less and we cannot do other things, we don't buy individual country sovereign bonds. We only buy credit guaranteed portfolios of all of them, for example, institutional changes that stop you from doing it. There has to be an alternative, which we've gone into in great detail. If the world ends, if we don't intervene, then they're going to find ways to intervene. So the pre-commitment not to intervene with sharply more enforced, reduced mandates, and that will make the euro stronger. I mean, I want to close before Klaus gets his 2 words in with a word of appreciation for the euro. We all think it's a wonderful thing. So this is not an anti-euro book. We are not anti-euro authors. Even me, who's an American, I think the euro is a great thing. And the vision of a common currency without all the claptrap that goes along in many other central banks. Central banks are about to be asked to, pay for reshoring manufacturing and subsidizing our industrial policy. No, central banks, our job is a common currency that has stable value, and that's it. And that serves many different countries' use of money. That's a beautiful vision. We all use the meter. The meter stays in Paris. The euro stays in Frankfurt. And we can all use this common standard to facilitate international trade, to have a steady currency that's useful for everybody. That's what the euro needs to be. And I'm kind of sad to see countries on the edge of the euro saying, no, I don't want to join. They should be rushing to join. They should be joining unilaterally. The euro should be the threat to displace the dollar as the world's global reserve currency because it's set up to be just a currency and not all this other stuff. Unfortunately, the euro has turned into a big, classic European Union mess of cross-country subsidies and fiscal transfers. And if you're Czechia or Poland or Denmark or the UK and you're looking at this, you're not saying, do I want to sign up to this great currency that everybody's using that's going to have a stable value forever? Or you're signing up to say, I want to join on this great cross-continent fiscal transfers that, like subsidizing French farmers. Now we subsidize, the Italian taxpayer, and that is going to be the grand bailout machine coming in. And you say, no, I don't want to join that. Well, that is what we'd like to, I would like at least to see restored. Klaus?
Wonderful what you said, certainly, and we make that very clear in the preface of the book that we are not anti-Euro or anti-European, and we think the Euro is a very good institution, but it needs to be enhanced, to be improved, and that's why we wrote the book. One aspect which I would add to John, certainly it helps if the next crisis happens, if some of the reforms were already implemented, we have suggested. And it would also help if the ECB had reduced its balance sheet, had sold the national government bonds on its balance sheet more swiftly. Because that, when you have a lot of, when a crisis hits and you have a lot of bonds sitting on your asset side, and you have a lot of short-term debt or deposits towards banks. We have seen in the pandemic, when the inflation started to increase substantially in the second half of 2021 and even more so 22, that it was very difficult for the ECB to stop even purchasing bonds. No? So when you already have a difficult balance sheet and the next crisis hits, you as a central bank are more in trouble than otherwise. So that would be, we would hope that there is some more courage at the ECB to reduce its balance sheet a bit more swiftly. And what makes us optimistic, we have outlined this also in our book in quite some detail, that there was a period between the start of the sovereign debt crisis and say 2012 and 13, where a lot of good institutional reforms were thought through, were initiated, some were implemented, like the SSM, the single supervisory mechanism, which is still working and working relatively good. So there are some reforms which work well. But we are saying that some other reforms like the ESM were kind of pushed away. They are politically not desired. And so there is a new reform momentum. And what makes us optimistic is that many people have praised our book. So perhaps some people are starting to think about some of the recommendations. Of course, that's a big hope. But no, I think Europe can reform when they see the need, and we can understand that currently with the geopolitical situation, it's that for many politicians, the euro, the architecture of the euro is not the first thought they have. They have the Ukraine war, they have the war in Iran, and so on. They have many other things. But perhaps some people start to think also about the issues which we have recommended in our book.
Thank you, Professor John and Dr. Klaus, for sharing your insights and helping us to better understand the past, present, and future of the euro. It has been a privilege to learn from your experience and perspective, and I am sure our listeners will take away valuable lessons from the debates ahead. Thank you once again.
Thank you very much.
Thank you. Thank you very much.